Luigi Zingales of the University of Chicago Booth School calling for an independent commission to look into the Fed, writing the following. In the last 2 years, the Fed has failed twice. It has failed to see inflation coming, and it has failed to see the banking crisis coming too. The nation needs a trustworthy Fed to combat inflation. The only way to recover this trust is through a transparent, independent and authoritative commission whose findings are believable. President Biden should appoint such a commission without delay. Luigi, I'm pleased to say, joins us right now. Luigi, good morning.
Good morning.
Is this the Fed chair's fault, or is this an institutional problem?
I think that's what we need to find out. I fear that it's an institutional problem more than just a chairman problem. It's easier to replace the chairman and to sort of rethink the institution. But I think that it's a very consensus institution. So I think the failures were shared and something has gone wrong.
Is that a polite way of saying there's too much groupthink at the Fed?
I think that definitely is the case, but I think maybe there is more. Maybe there are not enough economists, and so this is I think a low point on the board. I think only half have a PhD. So in economics, now you don't need to have a PhD in economics, but helps in understanding a situation like the one we're now.
What are they getting wrong right now?
I think that they're getting wrong how unstable the banking system is. I think that they have this idea that deposits are sticky. And I think that, first of all, we have never experienced in recent time a spread of 400 basis points between what you get on the money market and what you get on your deposit. And second, the world has changed. Deposits are mobile. They are really, Google say, a click away. And so I think that if deposits move in search of better yields, then banks have to realize their losses. The idea of losses held to maturity that can stay there and not have any impact, I think is sort of a fantasy.
Well, what do you think the Fed should be doing? I mean, at a certain point, this is really the consequence of banks not managing their assets well enough, isn't it? Or do you really think this really lies with the Fed?
No, I think that the Fed has a huge responsibility of the fact that they should have understood that they couldn't raise rates so fast. Because when you raise rates so fast, you're going to impose losses in the bond market. And who's going to bear those losses? Insurance companies? Then you have to bail them out. Banks? Then you have to bail them out. So unless all the losses are among us, investors, individual investors, then something happens. And so that was an extra reason to intervene early on the inflation. They were very complacent and said, oh, we have the tools. We're going to do it. We let it go a little bit, but don't worry because we have the tools. I think that their tools were not very sharp, and they should have recognized that.
How much do you think that the banking crisis that people talked about 3 weeks ago has abated, has really sort of moved from some sort of acute phase into perhaps a chronic question around flows and with respect to credit creation, but not necessarily a crisis?
I think it's possible and hopeful that it's not going to be an open crisis like we've seen in the past. However, clearly put a lot of softness in the banking sector, particularly regional banks, which we need to remember, those are the ones who lend to small and medium enterprises. The large banks tend to do syndicated loans to big firms, but the bread and butter of the economy is with the regional banks, and they are very soft, and they see deposits flowing out. And they are not going to make loans because if they make loans and then deposits flow out, they have to sell securities and they have to make losses. So I think that the first thing they do for sure is not make new loans. And then probably they're going to try to slowly divest their securities when they can. We saw there was an article on the FT showing that at the beginning of the year, cash over assets in banks were particularly low. And they say this is the cause of the current crisis. I said, no. This is an effect of the fact that we have a withdrawal of deposits. And so banks don't want to divest securities at the loss. So what they do is they reduce the cash they have.
The deposits, let's touch on that. You've been highly critical of the Federal Reserve. I'll be the last in line to defend the Federal Reserve, so let me be clear about that. But we do need to talk about the role of the banks in all of this. You got any criticism for the way the banks have been run?
Look, I think that if you don't expect some bankers to be stupid, you have not learned the lesson. And so Greenspan said that he was surprised. Was surprised how little people were trying to do the right thing, even if they had the right incentives. So we learn that people make mistakes. A resilient system is a system that can bear the mistakes of individual bankers, especially when these bankers are not the CEO of JP Morgan.
If I go and open an account this morning, if we went out, Lisa and I, and open a joint account, a surveillance account, without Tom's name on it, because we know what would happen to the cash, but that's another story. They'd probably offer us 0% for one of the big names. Still, we've got Barclays out in the last 24 hours saying that money market funds could go up another 1.5 trillion. Do you think the concern right now at the banks is return of capital or return on capital? And can they prevent deposit flight by quite simply just putting up interest rates on deposits?
No, they can't. They don't have the return to do that. If you look at Silicon Valley Bank, if they had increased the return on their deposits by, I think, 75 basis points, they would have wiped out all the profits last year. So I don't think that they have a return on assets that justify a higher deposit. That's the conundrum. If the problem were solved simply by increasing rates, it would be easy, but they cannot afford to.
So you're saying this banking system does not work with rates of 4% plus? Is that basically what you're saying?
Yes.
So does the Fed have to cut interest rates, and do we just have to tolerate inflation?
First of all, I think the inflation might not be as big of a problem if we get into a recession. I think the recession will do the job. Now, that was not the plan of the Fed. It was a soft landing, not crashing the banking sector. But that's a part that they should have seen.
But so let's just put this into perspective in terms of bad news being bad news, which seems to be the new theme in markets right now. How much is what you're talking about underpinning that there is an imminent tension that's going to perhaps accelerate some sort of economic downturn because the banking system just is not going to function at these rates?
I think that is the underlying bad news. Now, this is tempered by the fact that this will come with a reduction in interest rates. And as we know, that compensates some of the problems. So I think that the real tension is the Fed will not raise interest rate more, will probably at some point cut them. And is that going to be enough to transform what is likely to be a hard landing into a more soft landing? That's the question. I think that we are softening up and there will be a landing at this point. In my way, there is little doubt. The question is how hard.
Let's finish where we started. The changes you want to see. The changes you want to see over time, but I want to talk about the changes you want to see in the next couple of months. What would you like to see announced?
From the point of view of the Fed, from the point of view of the government?
From the Federal Reserve.
I think that a serious analysis of what are the softness in the banking sector. I think there was a regulatory failure, and the Fed needs to own it and change. And two, I think that be honest about the fact that probably we need to soften up interest rates because the banking crisis is coming, and try to find way to soften up this banking crisis, especially, I think, for lending on small and medium businesses, because those are the ones affected the most.
You said be honest. It implies that they know, but they're not saying it. Do you truly believe that?
I don't know what, you can be honest and being wrong. And I think sometimes people believe their own view of the world. I think that I honestly did not understand the 25 basis points increase last meeting. I thought that was just a signal to say, I want to reassure that things are not as bad as they might have been. Was not determined by the objective situation on the ground. But I've been wrong before, I can be wrong now.
I just wonder whether there's a role for regional banks anymore, which are such a mainstay of lending. I mean, basically under your paradigm, not really.
No, there is a very important role of regional banks, because we know that small businesses don't borrow at a large distance. They depend on local banks. And particularly also minorities depend dramatically on, for example, minority banks. I had students who went on the market this year showing how important is bank ownership in determining who gets the loans. So I think we cannot say we only go with a few large banks, because that means a complete change in the U.S. economy.
This was so good you can promo your podcast. What's it called?
Capital Isn't. What is working in capitalism and what isn't.
Nice. Where do I find that?
anywhere you get your podcast from.
There we go. That's perfect.
You were that good that he basically was like, go for it. You have won yourself
You can have
an advertising
a
spot.
10-second promo. Don't, I'll get in trouble with corporate now for giving that away.